Today's conversation is about what happens when a capital provider and a direct lender build their entire underwriting process around closing deals in days instead of weeks. National Business Capital CEO Joe Camberato explains what's actually being evaluated in that compressed timeline, where human judgment still beats automation, and what a high-velocity loan book reveals once the credit cycle turns. Let's get into it. Everyone, I'm Rita Garwood, Editor-in-Chief of ABF Journal. Joining me on the podcast today is Joe Camberato. Joe is CEO of National Business Capital. Joe, thanks for being on the podcast again. I'm excited to talk with you.
Yeah, always good to talk to you, Rita. Good to be here. Thank you.
Great. So traditional ABL underwriting is methodical by design, and that methodology exists for good reasons. What is the problem that you set out to solve, and why did speed become the answer?
Yeah, I think speed and convenience is, one of the best things that we bring to the market. It's a big value add of ours. Business moves fast, and we are big fans of ABL and banks and traditional financing. And I think there's, all types of financing really are all important and all have a time and place. But there's a lot of situations when you think about all the millions and millions of businesses that exist throughout the whole, entire U.S. At any given moment, a decent amount of those businesses have opportunities that came at a left field or a challenge that, pops up. And they need to really react quickly, and speed, can really make up whether they're going to either need the financing at all. But it can really just make or break them being able to execute, and nailing, an opportunity. So it's really important. And we've, pretty much all the deals we do are high growth companies. They're growth or bridges. We don't really work with, companies that are in bad situations. If they need a bridge, it's usually a cash flow bridge. They're growing, they're doing a number of jobs, or they're waiting to get paid from their accounts, and they want to take on more and do more, so they need a bridge, bridge the gap, or they're just growing fast, and something comes their way that they have to execute on. And I can't tell you how many deals that we've done. If we were only a day or two later in providing the financing, they would have just said no and not have a need for it because they would have missed out on that opportunity. So, when it comes to business, like, days make a difference, and 1 to 2 days can, make or break a deal.
For sure. So when you tell a traditional lender that you're closing deals in days, what's the most common objection that you hear to that, and what is your honest response?
A lot of times, a lot of folks know us and understand us, but there's still a good amount of people who do not. Usually they, they're either surprised or, think that we're maybe over exaggerating, and always ask, like, how are you able to do that? How can you underwrite, $1 to $5 million deal in days? We've, funded, $8 to $10 million deals in, 1 to 2 weeks. It's fast. But it's a combination of a number of things. We are built for speed. We have the infrastructure for it. And we've utilized technology for a long time now. Everyone talks about AI and technology, and we've been building tech, since I basically started the company in 2007, 18 years ago, and have always been improving the process. So, from a process standpoint, technology standpoint, infrastructure, we have that in place where we can, review an application and a financial package very quickly. And then we also have, a team in place that can move and react quickly. And we're very entrepreneurial in the way that we look at deals and underwrite. And if we have a full financial package, we can hop in a call the same day, next day with the client, and move right into a discovery and underwriting call and really get into motion. We've had, clients submit us deals, in the morning, and it's ready for, review, hours later, or, end of the day. And we can get on a call, and the technology and the process and the systems that we have in place really give us the ability to do that.
Awesome. So, can you walk us through the underwriting process at a conceptual level as a practitioner? What information are you actually making credit decisions on, and how is it weighted?
So, it all depends on the size. It's weighted, really more based on, the size of the deal. The larger the deal, the more in depth we'll get in our underwriting. But, we're pretty simple. We usually look at the last 1 to 2 years of financials for the business, year to date financials. And we want to look at, their cash flow over the last 6 to 12 months and really understand that. What we're really focused on is really what's going on currently right now. And then we really want to understand what their use of funds are for. So, very simply put, what are you using the money for? And, what is the opportunity? And then we want to understand how our financing can make that opportunity work. And our goal is to really get really clear on that. So we're obviously looking at the typical financial package that I think most would look at. And then from there it's really getting on the phone with the CEO or business owner and entrepreneur along with their team, and really diving into the opportunity at hand and how they think this is going to work, how they can use our capital to execute on their plan, and how it's going to benefit their business.
So, with every fast moving credit process, there is a theory of risk that's embedded in it, some implicit bet about what predicts repayment. What is yours?
Yeah, I mean everything that we're doing comes, is around risk, and we're really we're more managing risk than we are lending, right? So, obviously with speed, you really have to have your checks and balances in place and your processes really in place. The good thing about us is, we still have this entrepreneurial way about us. So, on smaller transactions, it's a little bit easier and faster and clear cut to underwrite. As the transactions get larger or more complex, then we dig deeper, and we don't have it set in stone where we have to fund someone in a week or less, or in 2 weeks or less, or whatever the time frame is. As we're going through our underwriting process and we find things, we'll dig for more. We'll ask for supporting documentation. And we obviously always want to move fast, but we don't want to move fast where we're taking on too much risk, that will lead to default. So we're it's like trust and verify. As we're moving along through a process and we uncover things, then we can continue to dig deeper. And if we have to dig deeper and it means us missing out, on a deal, or we have to dig deeper in order to get comfortable, and we'll hold to that versus just overlooking things. We're not going to overlook something that we feel like we need to get more clarity on.
So, traditional ABL lenders would point to things like field exams, borrowing base certificates, and collateral verification as core safeguards. When you move really fast, what's your equivalent? Or have you concluded that some of those are less essential than the industry assumes?
So we don't focus on collateral, so we don't have to do the typical field exam that an asset-based lender will do. But we, on certain deal sizes, once we hit a certain point, usually around $3 to $4 million, we will do an in-person site visit, and we'll fly someone out from the team there. The good thing is that we can make that happen very quickly. If we like a deal and we're moving fast, we can have someone out there in a matter of days, or even next day in some cases. So we've been able to react to that, very fast. But some of the other typical traditional things don't really line up for the way that we review things. And we also we'll look at financials. We don't necessarily need audited or reviewed financials. We do love them, and we love to get those. But we'll utilize other tools and verification processes to validate that information, and that helps us be able to be really flexible and move quickly, and not have to maybe need audit financials, but also be able to verify that revenue in a different way. So there's definitely unique things and the way that we have our process structured, where we still want to validate that information. We want to validate the tax returns that were being provided. And we use different tech, and platforms and different things in order to, to do that stuff, rather quickly.
So it sounds like my next question is about human judgment versus automation. And it sounds like you do have, people flying out for those larger deals. In all of your business, where does human judgment still live in your process, and where have you tried to automate and maybe pulled back from it and realized that humans were still necessary?
Yeah, I think for what we do, humans are a big part of the process, and we don't see ourselves as being this like AI platform, AI marketplace, and where no one ever has to speak to a human. We view technology and AI where it can empower the team, remove away redundant tasks, and streamline and speed up processes, and really turn our team members into superhumans, so to speak. And that's kind of how we're looking at AI and tech, and that's how we've always looked at it. Everyone was, I think, especially in this new non-bank lending world, there, and there's all different levels of non-bank lending, in the small to lower middle market, and especially in the small business side. I think initially everyone was trying to go so tech heavy, and then they realized that, hey, maybe need some real folks in the process. We've always been, let's use tech and great people together, and that's still our philosophy today. On the smaller transactions, sub $1 million, we're just able to move a lot faster, and we can rely more on our systems and tech and processes. But as you get, as you start to, break $1 million, $5 million, $10 million, those transactions always have much more complexity in the mix. They're more sophisticated businesses, and you just have to dig deeper, and that comes down to having great people on our team, great people in underwriting. But and also too, we're validating information, but we're also validating the human on the other end of the transaction, the borrower, and we want to make sure that that they're good people, that we believe in what they're saying. That we want to understand, do they really know their business, and whether they know their business, their ROI, do they understand are they really clear on, the amount of money that they're needing to borrow? Is that going to actually be enough to execute on their plan? Are they over borrowing? Is it too much? And all those things, that's where the human to human interaction really takes place.
So speaking of borrowers, what borrower profile and deal type is your model genuinely built for? And where would you slow down or decline a borrower entirely?
I mean, we are very industry agnostic. So we look at all industries. We don't do startups. But a startup is very loosely defined, word in today's world. You have companies that are doing 100 million in revenue that consider themselves startups, but we consider a startup as, I don't have revenue and I want to start a business. But, if you've been in business for, 1 to 2 years, we typically like companies in business 2 to 3 years plus. We are in all industries, all 50 states. Our core industries are construction, contractors, a lot of the blue collar trades, which usually have some of the biggest challenges at banks and ABL lenders. We don't underwrite those, and we really like them. We also like manufacturing, wholesale distribution, healthcare, and even restaurants. So it is a wide mix. And then, just because I didn't mention an industry, we still look at any industry, and really, it's a business that's been a business for a few years. They're growing fast. They need growth capital. They're doing revenue. They're breaking even, or profitable. If they are showing a loss, there's a real reason for it, and we can understand it. They have a true path to profitability, and what their capital, what our capital is going to be used for, is going to help, either continue to fuel the growth or bring them to a really good place. So, we're pretty agnostic, though, from an industry perspective.
So we've been talking a lot about speed. Are there situations where a borrower shouldn't want speed, and where the structure and friction of a traditional ABL deal is actually better for their situation?
It's funny, borrowers always want speed and the path of least resistance, typically. I think that, you know, when you maybe wouldn't want speed is maybe when you're doing an acquisition, you're buying a company as a business, and you want to make sure that you're taking the time to do the due diligence on the company that you're buying. Sometimes we're doing these deals where the owners, our clients buying it from another, business owner, and they're kind of working the transaction out, without like an advisor in the mix or an M&A group. But you want to make sure that, and I think those acquisition transactions, that you're really validating, the information. The good news is when you pull us in those transactions, we're going to validate the information on, the client side and the business that they're purchasing. So we kind of actually help, in that situation. Those deals sometimes can move a little bit slower. But I think that if you're going to borrow money where you're acquiring something or doing something, you want to make sure that what you're doing is really validated. You're taking the time on that. And you want to make sure that you're working with the right, advisor that's on your side that can also help, has the experience and can help validate the info. Because, the worst thing that you could do is borrow, millions of dollars and buy a bad company or, do a bad deal. And, we've seen situations out there where people are selling things or equipment and they're fraudulent transactions, and we've caught them because we're doing the validation. So, those are situations where, sometimes speed can hurt you, and you want to make sure that you're validating, your transaction.
So let's talk about credit performance. What does your loss data look like relative to what a traditional lender would consider acceptable? And what does it tell you about any trade-offs that you've made?
I mean, our losses are very, we're very good from a loss perspective. Compared to traditional lenders, I'm not exactly sure how we maybe would line up from, traditional lenders. But when it comes to the space, I think we're below most. And I think that really just speaks volumes to, our process and, and systems and, and our structure.
Right. So when credit conditions tighten, does a high velocity book behave differently than a traditional portfolio? And what does the cycle reveal that good times might hide?
Well, in good times, everyone thinks that their underwriting is great, and I think it's really important from a lending perspective, you just in all economies, you have to remain, disciplined. And I think that's where people get hurt. In good times and everything just performs well, people just continue to take on more and more risk. And some will really, really, go out on big limbs on deals. And when, there's a pullback or a shift, I think that's where, you see who is a really good underwriter and not. So I think that's one of the hardest things, for any lender, not just us. I think, as a lender, you're, in the business of, like I said before, we're in the business of managing risk. But, I think, mostly, lenders will say, hey, we're in the business of originating deals and funding deals. So, your business is structured where you want to just do more and more deals. Well, it's not just about how much you originate, it's, how much you can collect back. So I think staying, disciplined is one of the hardest things to do as for any lender. And the market is just ever changing and it's so fluid. And especially coming, out of COVID. I mean, these last 6 years, it bounced right back. There was free money in the system. Everyone thought they were the best underwriter in the world. And there was all this pumped up demand and it just looked like everything was going to keep going. And it's actually when I was like the most nervous. And I was saying this through that everyone thinks they're a great underwriter now because they're being fueled by government, money. As all of that got cleaned up and, dried up and was spent and that's when you started to see a lot of the cracks in the economy, a lot of cracks with lenders in their portfolios. And I think we're still going through this rebalancing period where, you have a lot of good and bad businesses mixed together. So I think right now is more important than ever to remain, diligent. And I think some have done a great job of that. I think, there's been some folks that, haven't, and they wound up, in the press where they've overlooked things. We also came out of this market in private credit where a lot of folks had got easy access to capital to deploy as a lender. A lot of new entrants into the space, and in those environments, you get access to a bunch of capital, and then you got to deploy it. And I think it's been a very interesting market where deal flow has been all over the place. It's been good, it's been bad. You speak to a lot of people, it's harder to find a good deal right now in this environment. So, if you got easy access to capital, through private credit or wherever, when the market was hot and now you're kind of sitting around a bunch of capital, that's when people start to overlook like basic underwriting fundamentals, and mistakes start to get made because they're just focused on deploying capital and not focused on the collection part of it. They're just focused on origination. So I think that's already kind of happened, and I think we've already seen some of those cracks, and I think we'll probably see some more of those cracks, as we kind of come out of this, bumpy economy.
So, last question I have for you. If you had to identify one thing that the ABL industry gets structurally wrong about underwriting, not a technology gap, but a conceptual one, what would it be?
I think there's a lot of good ABL lenders out there. I think the biggest thing, like from like a structural standpoint and conceptual standpoint, ABL lenders is, I think there's a lot of, a few good ones now that are realizing this. I think they've been behind the times with their infrastructure and technology and process. And I think if, they put focus on their process, systems, technology, and the way that they package and underwrite deals, I think they can move a lot faster, with still, diving deep in their underwriting and not having to sacrifice risk.
Well, Joe, thank you so much for being on the podcast today and having this conversation. I really appreciate you taking the time.
Thank you, Rita. Thanks for having me.